Okay, so picture this. You're looking around for a great offshore investment, right? And you come across this beautiful glossy brochure promising you a guaranteed, completely risk-free return in a tropical paradise. Southeast Asian real estate, and specifically Thailand, is constantly pitched as literally the investment of the century. But is it really? Well, in this explainer, we're totally looking past those flashy marketing campaigns. We're going to dive deep into the hard data that actually shatters these illusions of guaranteed wealth. So here's our agenda for today. First up, the Bangkok ghost town. Second, the anatomy of the trap. Third, the oversupply drivers. Fourth, legal loopholes and scams. And finally, we'll wrap up with investor defense strategies. Let's get right into it. All right, Section 1, the Bangkok ghost town, the reality of Thailand's property oversupply. So if you've ever been to Bangkok, you'll see this catchphrase plastered all over billboards up and down Sukhumvit Road. 7% guaranteed rental return, or GRR. It's incredibly tantalizing, isn't it? It's pitched to you as this foolproof way to generate passive income. But you really have to ask yourself, why? Why are developers so utterly desperate to guarantee you this kind of money? Right, and to answer that, we need to look at this absolutely jarring number, 1.64 million. That is the staggering amount of empty homes just sitting idle across Thailand right now. To put that into perspective, we're talking about 3.45 trillion baht in completely wasted economic value. That's a number nearly equal to the entire annual national budget of the country. It's wild. And when we zoom in specifically on Bangkok, condominiums make up a massive 58% of these ghost towns. The vacancy rate for condos has hit a really dangerous 24.8%. I mean, just think about that for a second. 1 out of every 4 finished condos is completely empty. They're drawing almost zero power, and it leaves us with an unsold inventory of around 58,400 units in Bangkok alone. Okay, moving on to Section 2, Anatomy of the Trap. The financial forensics of guaranteed returns. Now, the absolutely crucial point here is what we call the price inflation mechanism. In reality, market rents in Bangkok basically only yield around 3% to 4.5%. Developers absolutely cannot organically generate that 7% they're promising. So, here's the trick. Step 1, they inflate the sale price by 10% to 25% above the actual market value. Step 2, they take that extra cash you just overpaid and hold it internally in a reserve fund. And then, step 3, they literally just pay you back with your own money. They drip feed it back to you as a quote-unquote guaranteed rental yield over 3 to 5 years. You are essentially just financing your own returns. And this table brilliantly illustrates the massive gap between what's advertised and the somewhat grim reality. In scenario A, a long-term studio, the gross yield looks pretty decent, right? 5.14%. But once you factor in hitting costs and a 5% withholding tax, your actual net yield is dragged down to just 3.16%. Now, scenario B, a short-term Airbnb, boasts an amazing 10.17% gross yield. But wait, after massive platform fees, cleaning costs, and the little detail that daily rentals without hotel license are actually illegal in Thailand, your net is squeezed down to 4.17%. And scenario C, off-plan speculation? You're looking at zero income during construction, massive default risks, and a net yield of roughly 3.5%. All of this builds into what we call the 3 silent killers of foreign capital. First up, zero leverage. As a foreigner, you generally cannot get a local Thai mortgage, which means you're paying 100% cash up front. Without that leverage, your return on equity is severely capped. Second, exit taxes. Transfer fees, withholding taxes, and the specific business tax, those will eat up 4 to 6% of your sale value right out of the gate. And third, currency risk. The Thai baht frequently fluctuates by over 15% in a typical 5-year investment cycle, so your nominal returns can be completely wiped out just by a bad exchange rate. All right, let's look at Section 3, the oversupply drivers, why developers are desperate. What we're dealing with here is essentially a 5-part perfect storm. First, a post-pandemic supply dump. All those projects halted during COVID, they're now flooding the market simultaneously. Second, Chinese capital flight. Chinese buyers used to max out the 49% foreign ownership quota, but their sudden exit left a massive, unfillable gap. Third, over-speculation. Developers went absolutely crazy land banking along the newly expanded BTS and MRT transit lines, building high-density condos way beyond actual local demand. Fourth, there's a severe household debt crisis, meaning local Thai buyers are facing incredibly high mortgage rejection rates. And finally, short-term rental crackdowns. Strict state enforcement against illegal Airbnbs forced investors to dump their units onto the long-term market, which just crushed rental prices. This massive storm of debt and capital flight is exactly what forced developers to invent that 7% trap in the first place. Let's transition to Section 4, Legal Loopholes and Scams, when the countdown clock runs out. Now, you really have to pay close attention to this crucial difference. A bank guarantee is a highly regulated, state-protected, extremely secure financial instrument. But these guaranteed rental returns, they are almost always just a civil contract. It's an unsecured bilateral agreement. If the special purpose vehicle, the SPV company managing the project, goes bankrupt, your contract is completely worthless. Furthermore, developers routinely bury clauses in there that let them unilaterally terminate these civil contracts with just 30 to 90 days notice if, quote-unquote, market conditions change. And listen, this isn't just theoretical fear-mongering. Take the true crime story of the New Nordic Group. This was a jaw-dropping 3.4 billion Thai baht fraud. It really exposed how these guaranteed projects can literally operate as massive Ponzi schemes. They basically paid early investors just long enough to create a false sense of security, all while illegally building their mega projects on protected national forest land. When the new investor money finally stopped coming in, the payout stopped and the whole thing collapsed. Or consider this tragic case study from Phuket in 2024. A major resort developer declared bankruptcy, and overnight, 340 foreign investors lost their entire guaranteed income stream. Because they bought off plan, construction halted indefinitely, completely trapping their initial cash deposits. Now, you might be thinking, well, I'll just sue them. Well, good luck. Suing a bankrupt shell company in a Thai civil court takes 1 to 3 years and can cost up to 300,000 baht in legal fees. For most people, litigating is simply financially unviable. Let's move to Section 5, Investor Defense Strategies, How to Survive the Concrete Traps. Okay, so here are the absolutely essential, independent due diligence steps that every foreign investor needs to take before signing anything. Step 1, hire independent legal counsel. Never, ever use the law firm recommended by the developer. Just don't do it. Step 2, audit the foreign quota. You need to go directly to the local land office and verify that the building hasn't breached its 49% foreign ownership limit. Otherwise, you're going to be forced into a really risky leasehold. Step 3, demand SPV financials. You have to request audited financial statements to check if the guaranteeing company actually has the capital to back up its big promises. Absolutely. And when it comes to actionable investment alternatives, here's what you should be doing instead. First, refuse the trap entirely. Ask for an upfront discount on the purchase price instead of accepting that fake guaranteed return. Second, focus your capital on completed, ready-to-move projects in the central business district. The data shows these have a proven 93% absorption rate. They actually sell because they have real value. Finally, target high-connectivity microsegments. Think 40 to 50 square meter one-bedroom units within walking distance of central BTS stations, like Thonglo. You want to invest based on true asset value and organic tenant demand, not slick marketing gimmicks. Which leaves us with one final, pretty provocative question. Exactly. Are you investing in a property's true value, or are you just buying your own money back? It's absolutely a crucial takeaway. Look, the Southeast Asian real estate market can hold some incredible opportunities, but it demands absolute caution and rigorous due diligence. Thanks for tuning into this explainer. Keep learning, stay sharp, and above all, protect your capital.